welcome to Smaulgld's Dark Side series, where we discuss economic concepts and present the dark side of those concepts from an Austrian School of Economics perspective. Today we're going to talk about the dark side of artificially low interest rates that we're seeing all across the world at central banks. Public opinion always wants easy money, that is, low interest rates. And that was said by none other than Ludwig von Mises, one of the founding fathers of the Austrian School of Economics. However, artificially low interest rates are bad for the economy. And we've seen over the past decade the Federal Reserve using monetary policy to drive interest rates down, and they've done that by setting the Fed funds rate particularly low, and also through their stimulus programs, quantitative easing, which is basically the creation of dollars out of thin air, which they use to purchase assets. Now, Wall Street and Main Street have cheered on these lower rates because they make access to dollars cheaper. When you have cheaper access, people got more money to spend, their debts are easier to pay off, the government's debts are easier to pay off, and stocks and real estate prices rise. Well, sounds good, right? No, let's talk about the dark side of these artificially low interest rates. First of all, when you have artificially low interest rates, it discourages savings and investments, both by individuals and companies. When you have savings and investment, that's what you need. They provide the capital so that you can create productive capacity. And once you have productive capacity, you get products and services created, and that becomes a self-sustaining economy. The low rates discourage savings, as the rate on return is de minimis, and therefore when you have these artificially low rates, a lot of capital gets diverted from potentially productive investments, where there might be a long-term return on investment, and flows instead towards speculative ventures and assets, existing assets, like real estate, where people feel they can get a large return, especially a return larger than they can get if they just save their money. So a lot of the money that is available at low interest rates goes towards boosting existing asset prices, which means society doesn't gain more additional products, more services. It just reprices the existing products and services, reprices the existing real estate higher, reprices the stock market higher, just because more capital flows in that direction. Now, this can go well for a while because, as you've seen, the stock market rises, the real estate market rises. But eventually, if and when unprofitable speculative ventures go away, well, you've created nothing. All you've done is reprice an asset higher. Now that asset is priced lower. And if you use the low interest rates to buy stuff, well, you still have to pay the goods you still have to pay the bills on the consumer goods, which of course have depreciated in value. So when all this flushes out and you do reach a point where the bubble bursts based on too much cheap money fueled by artificially low rates, then companies crash, they go out of business, workers are laid off, and you start the cycle now of a economic recession. However, what central banks have done to avoid that, and this will be the subject of another dark side series video, they go to negative interest rates to forestall the problems and the cleansing that should have happened as a result of artificially low interest rates going on for too long. They move them into negative rates. Another thing that artificially low interest rates do is they encourage excessive consumption. Now, we've seen that artificially low interest rates already take away from the productive capacity that should have been built but wasn't built because the money was used to speculate on existing assets. Well, now you have, not only do you not have production being encouraged or increased, but you have consumption increasing without a corresponding lack of production. Why? Well, for the same reason that people can invest in the stock market and invest in real estate at low interest rates, consumers can do the same. They can borrow to take advantage of low rates, such as automobiles. They can buy boats, cars, trucks, light homes, in addition to buying real estate and speculative stocks. So you have this increase in consumption. So when money is on sale, as we say, we spend more. And when rates are artificially low, people and countries spend instead of saving or paying down the debt. What countries do is they keep the rates low. They don't pay down the debt. They just make their existing debt a little more manageable because they don't have to pay the interest on it. So low rates cause people to spend in excess of their income as they believe the economy is improving. This is where consumers are tricked. Not necessarily businesses. I think businesses know exactly what's going on when there's artificially low rates. But consumers see the low rates. They think the economy is improving. Good times are ahead. But when rates rise, debts need to be paid. There's been no corresponding increases in wages to pay for them. And why not? Well, the companies haven't really increased their productive capacity. They haven't increased their profitability. So how are they going to pay their workers more? Now, their stock prices may have risen, but that's not the same as actually increasing your productive capacity and your profitability. And of course, this works well in a US based type of consumer economy because 70% of the US GDP is based on spending. Well, low interest rates encourage spending. And if you're worried about the productive capacity, not so much of a problem in recent years. Why? The production happens overseas. It happens in China. And then the United States imports the goods, and with the low interest rates, they buy the goods. Now, this dynamic may all change in the coming years with the Trump presidency as he focuses on raising tariffs, perhaps, to stop the import of cheap goods and starts to make them in the United States. We'll see what happens. But for now, the dynamic is low interest rates means more spending, more consumption, more chasing speculative stocks and real estate. Now, there is this other concept of encouraging malinvestment. This is an Austrian school of economics theory that low interest rates, artificially low interest rates, send false signals. Now, we have another dark side series that we'll cover where I refute this Austrian school of economics theory only because the Austrian school theory assumes that at some point rates will go higher and then the malinvestment will be recognized and will be liquidated. What I see happening is almost a permanent manipulation of artificially low interest rates. And of course, when the Austrian economists came up with this concept, they never considered negative interest rates. So that's prolonging this whole cycle where you would think at some point the artificially low interest rates would create a speculative environment. Eventually the speculation and the bubble created by the speculation will bust, and therefore people will realize they made a mistake. They were tricked by the low rates, and therefore they now have to liquidate their malinvestments. That isn't happening, and I think also the companies that invest during these low interest rates are not tricked at all. They know exactly what the Fed is doing. They know about the Greenspan put. They know about the Bernanke put. They know about the Yellen put. They won't allow the stock market to go down. They'll continue to push liquidity. They will continue to lower interest rates. But under normal Austrian School of Economics theory, eventually that comes to an end. Now, they are right, eventually it will come to an end, except that the central banks have gone to such an extreme to prolong the period of time so that the business cycle, they've kind of smoothed it over where you're in this perpetual 7 years now of a stock market. And actually, if you go back to 1987, really that's when it started. The stock market's really been on a continual march higher with a few corrections that didn't last very long in between. And that's solely because of a very aggressive central bank policy of keeping interest rates low or lowering them whenever they see an issue in the stock market. But Austrian economists believe that artificially low interest rates would fool the entrepreneur into making these investments that they otherwise wouldn't make. I say they go full into them knowing exactly, and they fund their businesses knowing that they don't have to make a profit. They know they just have to get themselves launched to an IPO. We have companies out on the market that have been out 10 years, 5 years, 15 years, went to market, went to IPO without a profit, still don't make a profit, and yet have multi-billion dollar market caps. So businesses normally have to make a profit in order to survive. In the artificially low interest rate environment, making a profit is less important, but making money from your stock is more important. And what do artificially low rates also allow a company to do that perhaps isn't making a profit and their stock price is maybe not doing well? They can borrow money for next to nothing and buy their own shares back, thus pushing the stock market higher. Now, during all this, the company's not making a profit, but who's complaining? The stock price continues to go higher and higher and higher. And if it starts to go lower, we go to negative interest rates. And where else are people going to put their money if they can't get a return on interest? Why invest in a business that would actually make something and make a profit when you can put it towards these existing companies that don't make a profit but still go up year after year without making a profit and make the stock go up on promises and by doing secondary offerings and buying their own shares back? Let's talk about Keynes for a second. Now, people like to complain about Lord Maynard Keynes, and there's plenty to complain about. But what's going on in today's markets and today's central banks is beyond Keynesianism. Keynes was a proponent of stimulating the economy to bring forward demand when the economy was in recession. However, he also believed that there'd be a period of time when the economy did well and would actually have a budget surplus, which never happens, that you would pull the stimulus. We are now in a permanent stimulus. The countries are in debt with debt to GDP to 80, 90, 100, over 100%. So this is a permanent situation, whereas Keynes viewed the government intervention to happen only when the economy was in recession. That's where the government needs to step in and kind of boost the economy. And of course, even that intervention causes issues. And when these issues were pointed out to him, Keynes replied, in the end, we're all dead. So it's this type of thinking that tomorrow often comes, and the bills for yesterday's excesses, they've got to be paid for. But no politician wants to taste the medicine now. No central bank wants to have a recession on their watch. So they do these tricks. And what they're actually doing, and you're seeing it in the economy, you're seeing a disconnect between the stock market and real estate prices and the real economy, because people cannot afford to pay for homes that increase 5-10% a year when their wages don't increase 5 or 10% a year. The stock market doesn't reflect an economy that's growing at the rate the stock market is growing. So you can see that what monetary policy has done, artificially low interest rates, has boosted asset prices, but not necessarily the economy. Now, they also hurt job growth because low interest rates encourages savers to abandon fixed income asset investments like CDs and to chase the stock market higher, or maybe if they have a little extra cash, to buy real estate. But corporations do the same. They want higher returns. As we just mentioned, how do you get higher returns? You buy back your own shares. If you've got any cash lying around, or even if you don't have cash, you got good credit, you can borrow money to buy back shares. Now, how does that hurt job growth? Well, the company's obviously investing in its share price, not in its future profitability, not in its employees. Why hire employees? They cost money, not just for their salaries, but for their benefits, Obamacare, potential litigation. And the reason you would hire an employee is you think they somehow would add benefit to the company so you can make money. No, it's a lot easier to make money just buying your own shares back. So if they buy their own shares back, they're using cash. It's a good return on investment, a far better return on investment than hiring employees. They also don't invest in capital equipment. So you could say, well, maybe employees are expensive. The return on investment isn't that good, and especially in today's society and certain businesses, you're better off investing in robots. You can increase your production. You can increase your capacity. You can make things happen faster, more efficient. But the only reason you want to do that in the normal world is you want to make a profit and you want to have a sustainable business. But if the managers of the company are being paid to drive the share price higher, and you don't have to make these investments, and it won't show up for 5, 10 years that you've kind of missed capital investment for 5 or 10 years. You didn't invest in your employee base for 5 or 10 years, but the stock market went up for 5 or 10 years. Well, that group of managers has already made so much money on stock options and stock based compensation. They don't really care, and nor do their shareholders, because everybody's getting rich off the stock market. But the companies aren't really doing any better. In fact, they're falling further behind because they haven't made their investments. They've invested in their stock price. And there should be a correlation between the stock price and the profitability and the investments made, but that's not how it works anymore. Another reason to be against artificially low interest rates, obviously they cause asset bubbles. So as you see people pour money into these assets because there's no other place to put the money where you're going to get remotely a return on investment. If you're a saver, there's no point in putting money into a CD at low, artificially lower negative interest rates. And similarly for companies, you're better off putting your money into your stock, or if you're a new company, instead of trying to make a profit, again, try to make a killing on putting your company into the stock market and allowing people who also are taking advantage of the low interest rates to throw money at you. And then your stock price will rise. Another disadvantage of artificially low interest rates, it makes home prices unaffordable. Now we have another series coming up, the dark side of rising home prices. Well, one of the dark sides of artificially low interest rates is it makes home prices go up, and people say, well, that's great. I have a house. I like sitting around doing nothing and having my home price go higher. Yeah, but the people who want to buy a house don't like it. And what's happening now since 2008 is the home ownership rate has plummeted. Why? To the lows more than over 50 years. Because home prices are too expensive. The artificially low rates make real estate attractive to buy for those who can afford it, but they also make it, for younger first-time buyers, they push the prices out of reach. So while homeowners benefit, and you think about a homeowner benefiting from rising home prices, that homeowner may be a productive member of society in other ways, but he's getting or she's getting a windfall just by sitting around and watching the home price go higher. The house is the same house. The house isn't more productive, isn't doing anything different. It's still sitting on the same property. In fact, it's probably depreciated if the owner isn't keeping it up. So the fact that it's going higher without any corresponding increase in any real value other than it just still there shows that artificially low interest rates artificially boost the price of assets. It's the same house. It doesn't do any more, doesn't do any less, except get older. The other problem with artificially low interest rates, this is interesting because Democrats seem to prefer the Fed and its policies, but they're always banging on about wealth inequality. We have to do something about wealth inequality. Well, raise interest rates then, because low interest rates, artificially low interest rates, benefit those who are already wealthy, already have assets. It boosts the price of their assets without them having to do anything. Meanwhile, the poor, the middle class, who don't have assets and are not getting wage increases, just see the value of assets going higher, putting them further out of reach. They can't buy houses. Maybe they can buy cars at the low interest rate. That doesn't benefit them. They end up buying a car for, over a course of a 72 month loan. Sure, they can get a car, but the car doesn't build their wealth. The car just allows them to drive around and to pay for it over a long period of time because of the artificially low interest rates. And finally, another reason to be against, we got a few more, Artificially low interest rate, it punishes savers. People who already have passed their earnings potential and are retired or thinking about retiring, they can't live off of their savings. They've saved, it was a good thing to do. What are they going to do now? There's no income coming from the savings, so they have to invest it in the stock market, or they have to go back to work. And where do they work? Well, generally, retired people you see at big box stores, grocery stores, and so on, competing is another unintended consequence, competing with younger people who should have easy access to those jobs, but the employers tend to hire the older workers. They tend to be more reliable, and the older people don't really want to be there, and nor the younger people, but that's the price they have to pay to enter the workforce. So you get this weird dynamic where because of artificially low rates, you've got older people re-entering the workforce. Artificially low interest rates are inflationary. You may say, oh, we don't have any inflation. The inflation rate is low. Yeah, it would have been a deflationary period right now if they had not lowered interest rates to where they are. So artificially low interest rates are by their design meant to be inflationary, meant to boost asset prices. And they do. They raise the stock market. They raise the cost of living because the cost of homes goes higher. And the other thing people don't realize, the cost of cars is at an all-time high. People don't realize it because people used to pay cash for a car. They used to have a 2-year loan. Now they have these 6-8 year loans, and people say, well, the monthly payments aren't that. It's not the monthly payment. The cost of the car now is at an all-time high. So artificially lower interest rates do create price inflation. And of course, another problem is they cost a lot to engineer and maintain. The Fed had to print a lot of money. It has to lower interest rates. It has to have meetings. It has to be managed. And when you manage interest rates, it doesn't end there. Then you have to manage and manipulate. That's beyond the scope of this particular YouTube video. You have to manipulate a lot of markets to make sure you get the desired effect of the artificially low interest rates. And the other problem with artificially low interest rates is eventually they go higher anyway. You can only push the beach ball down so long. However, they have pushed it down for far longer than anybody thought possible. They've now come up with these negative interest rates. And my view is they can continue this game. They can go to negative interest rates. They can do that for years. They can get the stock market to go higher. But eventually what will show up in the real economy is this disconnect between what's actually happening in the economy and the stock market will be so glaring, and the standard of living will be so low for the people who are working versus the people who hold assets. So they can actually keep artificially low interest rates or negative interest rates to artificially boost the stock market. There doesn't necessarily, in my view, have to be a stock market crash. There could be an utter collapse in the economy and the stock market could still be higher. That's it for the dark side of artificially low interest rates. If you want to donate to Smaulgld, I'd appreciate that. You can do so here, or you can subscribe to Smaulgld. I'll send you updates. And please also, if you're interested in buying precious metals, not advising that you do so, but if you do, you can buy them through Smaulgld, through many of the precious metals dealers' links and banners on the site. If you do so, I get a small commission, and you pay no more, no less than if you had gone to these sites directly. So please check it out. Thank you very much.